Hello friends, how are you all? Okay, so today is our Ind AS 40, video number 5, and I taught you concept 5 in the previous video and we finished it. And what was this concept number 5 about? Concept number 5 was about the initial recognition of investment property. And initial recognition means making a purchase. Initial recognition simply means making the first entry in the books. So if you are talking about an asset and you want to make an initial entry in the books, it means you have purchased the asset. So the first thing is, accounting cannot even begin until we purchase the asset and record it in our books. This is called initial recognition. You need to recognize it, so you will have to make a purchase entry. And I taught you 5 methods on how to acquire an asset. First, you can purchase a built property from the market in cash. Second, you can build it yourself. Third, you can purchase on deferred credit. Fourth, you can get it in an exchange. And fifth, take it on a finance lease. And on finance lease, whosoever our lessee is, we assume that they are the assumed owner. The lessor in a finance lease, we assume that he sold it. He is assumed seller. The property goes out of his hands. And the one who takes it on finance lease is called the lessee. We assume him buyer and make entry in the book. So you could also be the assumed owner. We will also see how the assumed owner passes his entry. So there are actually 4 ways in which you can purchase, and in 5th, become assumed owner. In the previous class, I only explained one method. Purchase by cash, simple, just take purchase price and brokerage. And also take the stamp duty or take any expenses that may be included in the cost, okay? Which is related to purchasing. The expenses that are directly associated with the purchase of the asset, include it in cost, but only 3 expenses are visible in the market. So the first one is purchase price, second one is the transfer cost, and third is brokerage commission. I gave you a list of certain expenses that are not included in cost. First, advertisement. If you did promotional expenses for let out, they don't include in cost. An inauguration ceremony will also not include in cost. And if you refer to the study material, you will find it written in there as startup cost. They are startup cost ceremony expenses. You can write it down. In brackets, write inauguration cost is also called startup cost. Sometimes students think that I didn't teach. This is startup cost. And the third one I told you was day-to-day servicing for maintenance. This is not part of cost, but I made you write an exception: renovation. If you are building a wall, yes, I said wall, ceiling or flooring. If money is spent on these 3 renovation, it is considered capital expenditure and can be included in cost. Finally, the last point I mentioned was that all the taxes and duties you will count should be non-refundable. If government is going to refund the tax and duty, then it's not part of cost. They are expenses you spent and they returned, so they aren't cost. You only have to take non-refundable duties and entire concept is finished. We did a practical question in class, question number 15. And 2 questions were given to you all students for the homework, number 9 and 22. I assume you have done the homework, right? And I am going to start my lecture for today. These were given for homework. I'm assuming you have done this. Let's start my lecture for today. And this is case number 2. Self. Construction of investment property. Self-construction of IP. It may be possible. It's possible that the particular investment property that you want to let out for earning rent or for any appreciation, you won't find a ready-made one in the market. The market has ready-made properties, but you think they are asking for too much money. And we can build this similar property with less money. It's possible to build it with less money. So what needs to be done? In this, you will have to develop the property yourself. If the investor feels that he can build the investment property himself and it can be made cheaper than what is available in the market. So he will definitely try to save money. What will he do? First, he will purchase land from the market. He will buy a plot of land. If he buys the land, he will have to pay the purchase price. If you take any land with a structure, so its value is different. And if you buy land without any structures, its price will be different. So I purchased plain land from the market. The money is paid. Plus, stamp duty expense is unavoidable. Because you will have to register the property, right? So stamp paper charges will apply. Plus, if you buy a building or a piece of land, you will need a broker, right? How else would you know about the available deals? So you will also have to pay brokerage or commission. After incurring these three expenses, one more expense will be added. And we can call it development expense. And what does that mean? Cost of constructing the structure. And what will be included in this? Materials and labor and overheads. Materials, labor and overheads. When we build a building, we will need cement and we will need bricks and we will also need marble. Right? And we will need the labors also. There are so many expenses in building. And students, all the expense. Expenses related to building construction are called development expenses. So include material, labor and overhead in this. So since your building is ready, we will call this the cost of investment property. If you buy ready-made property, there will not be development expenses. If you buy land and then build a building, you will see development expenses there. You will have to keep track of it. But you need to keep two things in mind. Point number 1, abnormal wastage. If on the site where the building is being constructed, if you find any abnormal loss over there, so that is not part of the cost. Abnormal wastage will go to P&L. What is abnormal wastage? It means the material is stolen from the site. It's abnormal wastage and your negligence. The work that you had done on the building and you have been negligent and labor has done some faulty work, meaning the design that we provided, we did not watch out for it properly. And so they made the design wrong. Then they broke it and a new design was made again. So if there is any faulty work done, then the cost of that will go to P&L. It's not part of cost. It's abnormal wastage. And material theft or not following of the designs properly, then breaking it down and rebuilding it is called rectifying faulty work. All of these go to the P&L. This is your abnormal loss. So if you are given, put it in P&L. One more thing. You haven't studied in AS23 yet. I will teach you later. It's in your module 1 only. This is the first module I recorded on assets and liabilities. I have also included in AS23 in this. So when I teach you Indus 23 borrowing cost, so I will be visible in that. I will be saying if you have taken out a loan for any construction, so as long as construction is ongoing, you can capitalize the interest. And on the day when the construction work is completed, we will stop the capitalization of interest. You must have studied this in CA Inter in Accounting Standard 16. Capitalization of borrowing costs. Similarly, we have Indus 23. It's better to have knowledge in our minds that we read something like this, where you get permission to capitalize the interest. Okay, so if you have taken out a loan for construction, you are constructing a building and you took some funding from market. So until construction work is ongoing, till then, the interest that we will incur on the loan can be capitalized if the Indus 23 gives you the permission. Now you might be thinking why I did not mention this in the purchase. Because when purchasing, your interest cannot be capitalized in purchase because your asset is ready for use. You purchased a ready-made asset. So it's not taking time to prepare that. It's ready for use. So you can't capitalize interest. It can only be capitalized on items in the WIP stage. Those that take time to get ready for use I will explain this in detail in Ind AS 23, why we don't capitalize it in purchase and why we do in WIP. For now, just understand that if you took out loan for construction, so we can capitalize its interest in construction. This point is only related to construction. That's it, the concept is explained. Okay, so listen. In any practical question, the loan point of Ind AS 23 will not be asked. You would have been given a list for construction, simply add up the total. That's it. Let's move on. If interest is paid, then capitalize it. If any loan is related to construction, interest should only be capitalized during the time construction work is ongoing. Once construction is completed, interest goes to P&L. So only the interest on the WIP stage. It is allowed inside 23. Why is it done? What's the reason? We will see in 23. Get a top helicopter view of this point. Well, it cannot be that I open in AS 23 for one point and then finish my lecture while explaining only that, right? We have to study this further, then why should we waste our time? We will keep this point in mind. Now you are saying to me that since the day I started teaching you in AS 40, I have also been giving reference to other Ind ASs. This and that Ind AS. I told you in the previous lecture, if you use the property, it goes to 16, and for agriculture, it goes to 41. If it's held for sale, then 105. If it's kept for mineral oils, then 106. If we sell it in near future, it goes to Ind AS 2. And then I began explaining its relationship with Ind AS 116. And today I am referring to Ind AS 23. So this is confusing you, right? It's CA finals preparations and nothing else. I can't keep telling you in class that the final exam is easy. Some people say that to motivate the children for exams. They say things like, it's very easy and you can do it. I don't talk about useless things. This is a very difficult task. You should understand this today. I talk practically. CA final is not a joke. Because after your final exam, you will receive your CA degree. Having a CA degree means people will come to you for their financial statements. And you will feel responsibility. So if you are going to become a responsible person, it cannot be that easy. If a child chooses medical, he wants to be a doctor. And if the person teaching him says being a doctor is child's play, that's wrong because he's going to be responsible for people's lives. So please study with responsibility. And about an LLB, being a lawyer is easy, but responsibility is immense. You will represent your client in court. So becoming a professional is not that easy. And if a child becomes one without knowledge, then their life is over. What will they do? I get tired of telling the students to please study responsibly and become a responsible person. But then nobody here listens to me. Everyone wants the 1 crore rupees and the 50 lakh rupees package as the starting package. Everyone wants a good salary and a good life. For that, you will have to invest your time in study. There's a chartered accountant who earns in crores and another who earns approximately 50,000 only. Don't blame it on the market. The fault for this situation lies within you. Wash your brain and stop looking for shortcuts. Believe that I want to become a responsible person and be responsible for people's finances. It is easy for me to come on YouTube and keep talking, but it's not that simple. You have to study harder. You have so many references. Keep in mind where each of these things goes. Write it down. As per the provisions of Ind AS 40, as per the provisions of Ind AS 40, it may be possible that The investor develops property itself. Instead of purchasing it from the market, the following statement shall be prepared for computing cost of self-constructed property self-constructed. Right here statement showing cost of self-constructed. Statement showing cost of self-constructed investment property. Write first of all purchase price of land. First, you need to buy land you cannot build in the air. It cannot be built in air. Purchase land. Then we will add to this transfer cost. It's called stamp duty. Then we will add to it brokerage commission. Brokerage commission. It's correct. Then we will add development expenses. What are development expenses? Expenses incurred on construction or building in the form of material and wages and overheads. And this will be the total cost. Additional points to be considered. Additional points to be considered. Additional points to be considered. The first point is on abnormal wastage or on the losses. If any, abnormal loss takes place. On the construction site, then it will be written off in P&L account. It means that it will not be considered as a part of cost of IP. Loss of materials, due to theft, loss of material and labor due to faulty work on site. Abnormal loss can be anything. The laborers fought at the site. The laborers fought. So then they fought aggressively and beat each other up. So the police arrived. So we had to pay and our work on the site also stopped. These come in abnormal loss category. What is the issue? The abnormal loss is never a part of the cost. Second, interest on borrowings. If any loan is taken for construction of building, then interest can be capitalized to the cost of investment property. Under the guidance of Ind AS 23, These are in accordance with Ind AS 23. And Ind AS 23 says, you can capitalize the interest until the completion of the construction. As per the rules, we can capitalize the interest to the cost of IP till the date of its completion of construction work. For detailed analysis, refer to Ind AS 23 if you need to refer in details. Only Ind AS 23 will tell us. It's just a brief information. You can capitalize the interest up to the construction. That's it. So what is the difference between construction and purchase? We will purchase land first. Then development expense will come. Abnormal loss in development expenses should not be taken. It will go to P&L, you can take interest and capitalize the interest. If you took out loan for construction, include interest in it until it completes, because then the interest will go to P&L. Till the date of its completion of construction work. After completion of work, interest cost will be written off in I will make you write this in Ind AS 23 as well. That if you have not repaid the loan, your interest is accruing. Your construction work is completed. The interest after the construction work is completed, put it in P&L until construction is ongoing. What is the fundamental logic behind this? We will discuss that detail in the Ind AS 23. You know, I don't teach without reasoning. I'll give reasoning for everything. So trust me, we will read this. It's simple. Case 3, and this is purchase of investment property on deferred credit Let's mark this. Important. This case should be in your knowledge, because this is concept that you did not study in Inter. This is a brand new fundamental for you. And after reading this, your eyes will open. Okay? And you will be surprised seeing this point in Ind AS. Purchase of investment property on deferred credit. And one thing to keep in mind is that this concept of deferred credit will be found in all of the Ind AS. You are reading Ind AS 16 of PPE. Did you purchase property, plant or equipment on deferred credit? Concept is same. If you purchase an intangible asset under Ind AS 38 on credit, concept is same. If you purchased an inventory in Ind AS 2 on deferred credit, then whenever you purchase an asset on loan, concept will be same. It's in all Ind AS. And you know what this talks about? This talks about the time and value of money. Your eyes are about to open. You will learn something new. There's a company called X Limited. And this company X has acquired an investment property. The company has acquired an investment property through a purchase agreement with Y. And they told this Y that the down payment I am providing is 50 lakh rupees. 50 lakhs. And the remaining 50 lakhs will be paid to you after 1 year. This means that they have made the deal between themselves. The deal that they have made between each other, it will be worth 1 crore rupees. We can say that this X has purchased a building for 1 crore rupees and the Y has sold the building for 1 crore. That's what it means. And Ind AS 40 does not accept this. Ind AS 40 states that this amount of 1 crore rupees represents the total amount of your gross payment. You cannot refer to this as cost. You are paying 50 lakh rupees today as a down payment out of the amount of 1 crore rupees. So, we agree with you. But the remaining 50 lakh rupees will have to be paid by you after 1 year. So, after 1 year, there is the inclusion of both an interest component and the time value of money. So, it would be incorrect to state that 1 crore rupees represents the cost of your property. The gross payment cannot be capitalized as a cost of the investment property. So, what are they attempting to convey? They are stating to apply the discount. The cash outflows here that we have, cash flow 1 and cash flow 2. Discount both of them. I asked what the discount is on and it's stated that it's on the market rate. I said what will happen if we discount at the market rate? It stated the present value will be determined. So I asked what would happen if we calculate the present value? So it's stated that the present value that will be calculated will be recognized as the cost of the property. Now, let us assume for a moment that my market rate is 10% and I need to calculate its present value. So the down payment of 50 lakh, its PV factor will be 1 because it is being made today. But either remaining 50 lakh which is due in a year, I will apply. 909, the first PV factor based on 10% is calculated 1 year later. So, if I multiply 50 by 0.909, then it will be 45.45, the total 95.45. So I will pass the entry. This is the investment property account debit to the bank, 50 lakhs, and to creditors, 45.45. The first entry is passed. Now see what happens next year. So after 1 year, this is the initial recognition. So now it will be subsequent recognition. Subsequent recognition means at the time of payment after 1 year. I am going to pass the second entry. When I have to pay in installments, it is called subsequent recognition. Subsequent recognition means accounting after initial recognition. So I'll first do the interest. Interest account debit to vendor, which means creditors. So 45.45 multiplied by 10%, I was supposed to pay this. I am including the interest. When I calculated the interest on this, it came out as a figure of 4.55. Now I will pass the entry. Creditors accounts debit to bank 50 lakhs. That means my creditors account. I passed an entry in it by investment property. Then I wrote by interest 4.55. So I wrote to bank 50. And this interest will be credited to P&L. This interest cannot be considered as part of your cost. We will add another entry, P&L account debit to interest 4.55. Now you must be wondering about this. Jindal sir, what are you doing? We studied for the CA Inter that we consider the amount of money we pay as the cost. We paid 50 lakhs rupees today. We will pay 50 lakh rupees after 1 year. Our total payment is 1 crore rupees. So the cost of the investment property should be considered only 1 crore. Students, what we state in Inter is absolutely right, because such a concept does not exist in Inter in the accounting standards. But the Ind AS is completely inspired by the IFRS, absolutely, and you already know about this. In the international market, the concept of the time value of money is applied very significantly. They say 50 lakh rupees that you are paying today, we agree with you. Its current value is 50 lakhs, but the payment that will be made a year later has an interest component in it. How are you capitalizing it in the cost? So first remove the interest. Find the present value. Consider that present value as the cost. And the interest due on that will go to the P&L. We inquired about the source of the interest. This is purely notional, merely a hypothetical calculation. It's advised not to do that. The concept of the time value of money cannot be denied at all. We studied in FM. If it is 50 lakhs today, it won't remain 50 lakhs after 1 year. Over the year, it will generate returns and increase by a certain amount. So the payment you are making after 1 year, you will have to pay 50 lakh rupees. So its value today would be less than the amount of 50 lakhs. So calculate the interest amount separately, which is included in the market rate. This has to be done. We have no choice. And I'm very impressed with this concept. That's absolutely right. So we have one important point to understand here. If you have any payments to make on a future date, so the payment that will be made on a future date, you should discount it by the market rate and bring it to its present value. That will be your cost of investing in the property. And when we calculate the interest on it, that interest will be written off in your P&L. So the payment of 50 lakhs rupees that you are making after 1 year, don't think of that person as a fool. If someone is telling you to take the property now and also telling you to pay for it after a year, and he is not foolish, he will take 50 lakh rupees from you a year later and he knows there is an interest factor involved. He is charging you interest. He must have designed the price in a way that his interest is also included. Nobody will give you a 50 lakh rupee interest-free loan for a year. It's impossible that you find such a person anywhere. And Ind AS are applied to companies, and those companies are run by educated people who are not dumb at all. If any transaction involves a future payment, you can be certain that the future payment implicitly includes an element of interest. You can't see it, but practically it's in there. Don't think of the buyer and seller as fools. Okay, so this was the concept. The first entry, investment property account debit to bank from the down payment to the creditor from the amount borrowed. Then comes the time to pay the installment. Okay, so we will do the interest first. Interest account is debited to the creditor. Interest has become due, then credited to the bank. The interest will be credited to the P&L and won't be included in the cost. Okay, it's right. The interest can be included in the cost, but in just one case, and that is in the case of construction, because Ind AS 23 allows it. The rest interest go to P&L. When you make a purchase on deferred credit, you have to follow certain steps. The first step, calculate the present value of all the future cash outflows. Calculate the present value of all future cash outflows at market rates. Second step, pass journal entry for making the interest due. The next step, record the payment of the installment. The next step, transfer the interest to the profit and loss account. And it is done. That's all you have to do. This is the concept. I will also cover questions and examples about it. You need to understand this. Let's go through this. This is a very good concept. I was so excited when I first studied it in Ind AS. I have also recommended this in AS2. When I was in the Accounting Standard Board, While I was on the accounting standard board, I am sure you all must be wondering about it. For you, it might be a big deal to be on the accounting standards board, but according to the time that I have dedicated to this profession, I could not do much for the institute. I am busy with my teaching and profession, so I cannot allocate time. Although the institute staff consults me, but I lack availability. I have worked at the accounting standard board for 2 years. And sometimes when an opinion about practical case studies is required, then I have an involvement in that. I also tell you that if you are working in a good firm and facing difficulty with an AS compliance in practical case, then you can take my help. I will definitely guide you free of cost. You can send me your case study and I can help you with it. Now start writing. As per the provisions of Ind AS 40, as per the provisions of Ind AS 40, we should not consider the gross payments as cost of the investment property if property is purchased. On deferred credit. The following steps should be applied while making accounting entries under the specified case. Please note down these steps carefully. These are very important steps. The first step. Calculate present value for all future cash outflows. That market value at market rate and recognize it as cost of investment property. All your future payments and your payments, discount them all. I have run out of pages. I'm writing on the next page. Please write this down below. Take note of this below. I can write the cost of IP. We will write in this all cash outflows multiplied by PV factors. PV factors at market rate and the journal entry will be passed. Investment property debit. To the bank. The payment to the bank will occur only with a down payment. You know that the down payment is your cash outflow and the PV factor of 1 will be applied to it. And your future payments will be discounted. 2. Creditors. The money that you have not paid will be booked under the name of creditors. This is your outstanding balance. We write being property acquired on deferred credit. Property acquired on deferred credit. First, you need to discount the cash flows and then pass this entry. Then you have to go to the second step, and this second step will be called as subsequent recognition. At the time of payment of installment. You can write the future date. Payment and future date. When it's time to make the payment, first we will write interest expense debit to creators First, we need to do the interest. How is that calculated? Outstanding balance at the market rate. You would have gotten this from the first step. First, the interest is calculated on the outstanding balance, and we will write being interest made due. You have made the interest due. We have reached the second entry. Creditors account debit to bank. Now make the payment you want to. And you know that the payment you are making, it has both the principal and the interest. Because you have added interest to your creditor account. So the payment is carrying both these things together. Being payment made being payment made to the creditors. And this interest we will write off. The interest expense and it will not be considered as cost of IP. Let's suppose we won't include it in the cost, instead we'll record it separately. Profit and loss account debit to interest expense being in deferred credit, the time value of money is mandatory to consider. This is not an optional concept for you. On the basis of the given explanation as in above, we can understand that Ind AS 40 considers time value of money concept in the case of payments at future date. Here you go. This concept is centered on the time value of money. Write an example, then we address a question. A Limited acquires a property from B Limited in the following terms. Let's continue. If you are lagging behind in taking notes, you can pause and can take proper notes. You already know everything. You are young students. I always advise you. I just keep telling you things. As a teacher, I am used to this. Even your parents habitually correct you. And so do your teachers equally. But trust me, in life these two are the only people. First your parents and then your teachers who want your welfare. They take pride in watching you grow and are genuinely happy when you succeed. The day you become successful in your life, your entire friend circle will be over. You might have 50 friends today. You might have even hundreds of friends. But the day you outshine them and achieve success, all your friends will leave you on that very day. I have had a lot of experience. We were the same age as you are now. We also had friends. We had our own circle too, but as we advanced in life and found success, many people were left behind. Remember that in your entire life, there are only two people who genuinely take joy in seeing you succeed. One is your parents, your mother and father. Their eyes fill with tears of joy as they watch their child succeed. One is your teachers who will always pat you on the back. A teacher feels proud that he has taught this student. If today the head of Amazon company is my student in Dubai, then I would feel proud. How can I be envious of that child? I will be happy. That student would still respect me. If the CFO of Vedanta Metals, Pushpendra Singh, is my student, then I will feel so proud of him. Interestingly, they still respect me and keep in touch today. I still have everyone's mobile numbers. They message me saying that, sir, we still remember what you taught us. I am very proud of these things. Please write it down. In point number 1, payment after 1 year is 10 lakh rupees. Payment after 2 years. Payment after 1 year, payment after 2 years is 10 lakh rupees. Market rate is 10% per annum. Pass accounting entries. From the date of purchase. Of IP. Till the date of actual payment under Ind AS 40. You need to do the full accounting. In this example, I haven't taken a down payment once. I have taken 2 payments. One is after 1 year and one is after 2 years. You will have to take 2 discounting factors. The first step is to calculate the present value. This is the first step. So if you want to start the accounting, so first we will write calculation of present value of cash outflows. Calculation of present value of cash outflows first is first payment, second payment. First payment is 10 lakh rupees. The second payment is also for 10 lakh rupees. Both payments are 10 lakh rupees each. PV factor 909 826 1 upon 1 plus R. I hope you remember this formula. I can expect this much. So you need to do 1 upon 1 plus 10%. So it will become 1 upon 1.1 is equal to first PV factor will come, and then press it second time, next one will come. Just a small matter. When I explain these to final year students, I feel like it's like that I'm showing a lamp to the sun. How can I possibly tell you children such small things? Sometimes students get upset at such things, right? I will only tell this, which will get your work done. 9,09,000 rupees. And 8,26,000 rupees. So students, last year I was in London. I was on a vacation in London and I passed by Madame Tussauds. Madame Tussauds is a museum in London where they keep wax statues. As I stepped out with my family, I saw a restaurant in front of me. So there was a couple sitting there looking at me. Young couple. Well, personalized good couple. The boy was handsome and girl was very beautiful. They were newly married. They were also visiting London. They were looking at me. Then I understood that they are my students. That's why they were looking at me. I am not interesting. So I went to them myself. Then we started talking and they said, we are your students. That boy and girl both were my student and they had a love marriage. They both were settled in Dubai. They came to London for vacation after marriage. What else does a teacher need? My son behind me said to me, Dad, here too? Students found you here too. They have not found me. It's their love. Students could have ignored me if they wanted to. They gave me love, recognized me, and showed me respect. This is their love. Right. That's why I keep saying this. Study. Student success is everything in life. Until you start devoting your time to the subject will never provide you opportunity of growth in life. You have to give them time. 17,35,000 rupees. I have come to second point. I am talking about accounting entries. So firstly, I have the initial recognition. Initial recognition. What entry should I pass? I will pass the entry. Investment property debit. Investment property account debit to the creditors. I purchased the property on loan. 17 lakhs, 35,000. And being property acquired on credit, being the property acquired on credit. So when is the first payment due? The first payment is due in 1 year, so you will have to pay interest on 1735. So come with me, I'm taking you all to the next page. At the end of first year. At the end of first year, at the end of the first year, at the end of first year. First, I will write interest expense account debit to creditors. So 17 lakh 35,000 rupees that I have recorded initially you will be charged 10% interest on this, according to market rate, 17,35,000. Okay, I would say being interest made due. Second entry will be, I will pass the second entry, creditors account debit. How much is first payment? 10 lakh rupees to bank. And being payment made, being payment made, accounting of first year. Let's move on. Let's see. Okay, you can also pass one more entry if you want to show it. Profit and loss account debit to interest expense. You can show this entry. Being interest written off in profit and loss account. At the end of the second year, I've reached the end of second year. At the end of second year, I will pass the first entry in this. Interest expense account debit. To creditors. For this you will have to keep a record. So you had passed your first entry with 17,35,000 rupees. You had due interest of 1,73,500 rupees. And you made a payment of 10 lakh rupees. So you will have to do a rough calculation. What is the balance in your creditors account? So, what is the balance in your creditor account? Balance will come 908500. If I take 10% of this, then this becomes 90850. I added this. So students, this becomes 999,350. I need to make a payment of 10 lakh rupees. It's a difference of 650 rupees. So you know that we had taken the PV. Factor up to 3 decimal. Because of the PV factor, when we take it to 3 decimals, because of it we have to round it off slightly. So in the last year it's better that you take interest as balancing figure. If I take this according to the rate, it becomes 10%. And if I add 650 rupees to this, according to the rounding off, so this will become 91,500. And this will be a perfect match. The difference that comes from this, the interest on 91,500 rupees is approximately 650 rupees. Due to the PV factor, there will be a slight difference. I will write interest account debit to creditors 91,500. And for this I will say that refer. Creditors account, I will show you how to make it. Interest made due. I will pass the second entry. Creditors account debit to bank. and I will write being. Being final payment made. The final payment made to the creditors. I will write third entry. Interest. Okay. Profit and loss account debit. Okay. What is happening here and what is this? Why are these mistakes happening? This payment is 10 lakh rupees. And the profit and loss will go in P&L. Being. First, we need to discount all the payments and then consider the interest along with them. So if I make this for you, creditors account. I will write by investment property account 17 lakh 35,000. Then I will write by interest 10% 173,500. Then I will write to bank 10 lakh rupees to balance CD. This will be the balancing figure. This is our first year. One, so it's 9 and 0 and 8. 500. So students, it is 19 lakhs 8,500. And here it will be 9 lakh 8,500. This was our first year. We are now in second year. Here we will write 9 lakh 8,500. We will write to bank. ₹10 lakh. Here we will write by interest. This is round off. Okay. We cannot reduce the payment. The payment has to be made of 10 lakh rupees, not any less than that. We increase the interest rate. Then we increase interest. This is the concept. I don't think there should be any problem. If it is a self-construction case, land, stamp duty, brokerage and development expenses, you can take interest. Put the abnormal loss in the PL, concept finished. If you buy on deferred credit, you need to record it at present value, then add the interest and put in P&L. Upon my saying, let's see question number 18. Here, question 18. Mark this as important. Write deferred credit in front of this. Question number 18, I will read it to you. Okay, students? X Limited acquired an investment property. If any student wants time to read the question, they can pause the video to read the question first, then they can resume. Someone's note taking is lagging behind and I'm moving ahead. You can pause and take notes. You will all manage the speed easily, I know this. So let's read this. X Limited acquired an investment property under a deferred payment plan. The down payment on the date of acquisition is 50 lakhs. In this, there's a down payment of 50 lakhs. PV factor 1 will be applied to down payment. Because today 1 rupee is worth 1 rupee, there is no interest on it. After 6 months, 1 crore 20 lakh rupees. After 1 year, it's 5 crore rupees. And if you look carefully, 0, 6 months, 12 months, this means that your payments have a 6-month gap between them. All payments are designed at a difference of 6 months. The interval time is basically 6 months. You didn't understand. The payment is not going after 1 year. The payment is going after 6 months. So the interest rate that you have, the borrowing rate that you have, that is 11%. So students, we always assume this interest rate on an annual basis. Okay? Whether it is written or not, the rate is per annum. So now students, I have to convert this into a 6-month rate. So this will be 5.5%. Now students often ask me on WhatsApp, that sir, why are you converting 11% to 5.5%? If your payments are made 1 year after another, so interest on it also applies 11%. If payment is due in 6 months, so interest will be charged at 5.5%. Why? Because you have to calculate the balance every 6 months. Interest will be due every 6 months and the payment will be made. Then balance will be calculated again, then interest will be charged on it. So the interest calculation will be done every 6 months. So you will need to adjust the interest rate. This question doesn't have quarterly payments. So students, the rate that we would be taking is 2.75%. Interest would go around 4 times. First, we would do interest due for 1 quarter and then payment. Then 1 quarter, then again payment. You need to calculate the interest on the basis of balance. So if balance is to be taken after 1 year, then take the rate for 1 year. And if the balance is taken after every 6 months. A student sent me a suggestion. So I received a suggestion, but what was the suggestion? It was that, sir, you should take the PV factor for 5.5% on this. Take 11% on this. It's wrong. What are you talking about? You didn't even listen to what I said. What did I tell you? I will first write. Inside the creditor's account, what I am trying to say is that I will write by investment property. Then I will write to bank. This is down payment. I will write by interest. 6 months, I will write to bank. This is the first installment of 1.2 crore. Then balance. This balance will come here. Now tell me on this balance. So on this balance, will you take interest for 1 year? No. You will have to calculate the interest on this balance for 6 months. Students, this balance is coming from here. And this balance is coming from here. So you have your cumulative balances. Therefore, you cannot take different interest rates for payments. You need to do according to cumulative balance. You need to calculate interest of 6 months here and also here. In this entire question, the yearly interest cannot be calculated. You will not deal with all the payments separately. That this payment has 6 months of interest. This payment includes the interest of whole year. Interest is calculated on balance. So then your balances are carried forward on a timely basis. So I taught you about hire purchase in Inter, right? In CA Inter, hire purchase. Hire purchase is removed now. Your new syllabus is in CA Inter, only AS is left, okay? Hire purchase is gone in the foundation now. The students who came after completing the old syllabus for the CA Inter must have studied it from me. If installments are quarterly, make the rate quarterly. If half yearly, make it half yearly. 2 yearly installments are also shown to you. So this rate of 11% becomes 22%. Therefore, you need to adjust the interest rate based on the gap between your installments. So this should be in your knowledge for your exams. And the choice of the rate, don't calculate based on payment. Calculate it according to their time interval. You need to look at the time interval of each installment. The payments you have designed for 6 months. If it was for 3 months, then quarterly rate. If 2 years, then double rate. If it was annual, then 11%. What is the question? It says find out the cost of the property. At initial recognition, we will do it. How should X Limited account for the difference? I will show you how to do accounting for interest. Question number 18. Calculation of present value of cash outflows. How will it be? First, the down payment. First payment. Second payment. What is the down payment? 50 lakh rupees. So the PV factor will be 1. The second payment is 1 crore 20 lakh rupees. Third payment is overall it's third, but installment wise it's second. And the third payment is 5 crore. Seeing such large figures makes my hands tremble, especially when the amount reaches crores. Because I have never seen such a large amount in my life. We will take 11%. 6 by 12. This will become 5.5%. 1 upon 1 plus 5.5%. So this is the first PV factor, 948. And the second PV factor will come when rate is half yearly. PV factor will also become half yearly. So this will remain at 50 lakhs. One crore, 13 lakh, 1 crore 13 lakh and 76,000 rupees. Four crore 49 lakhs. Total present value of cash outflows. $50 lakhs. Six crore. 12 lakh and 76,000 rupees. So the initial recognition entry will be passed. Investment property debit. $61276. to creditors, to bank, to creditors. So the down payment is 50 lakh rupees. Okay, students? Then you can just book the remaining amount. 562, 76,000. And being investment property acquired. If question had said, pass journal entry. If question has asked for journal entries, you can pass them. Otherwise, we will create an account and write the treatment of interest. Do you understand? I am not passing the entries. First, I will write buy investment property 612 76000. Then I will write to bank. The down payment is 50 lakhs rupees. The payment is done. Now I will write by interest. First tell me how much balance is remaining. 5 crore 62 lakhs. 76,000 rupees for 5.5% interest will be due. 5 crore 62 lakh 76,000 multiplied by 5.5%. 3095180. Now we will write to bank. The payment is of 1 crore 20 lakh rupees. First check the balance. Balance CD. We are calculating the balance to prevent errors in the sheet. Please don't ask me questions like who calculates the balance after 6 months. I'm just doing this for your accounting convenience. So that you don't make any mistake. 612 76,000 plus 3095180 total. 643711180. 643711180. In total, we have 4 crore 73 lakhs 71,180. Balancing figure. We will transfer this forward. Four crore 73,71180. Now we will write by interest. And here to bank, you know well, to bank is 5 crore rupees. This is 5 crores. If I look at the difference between these two, it's showing as 26 lakhs, 28,820. And if I apply a 7.5% interest rate for 6 months on this, so students, it will be 26 lakhs, 5,415. but the amount is in crores. There is a difference of 15-20,000 due to the round off. What is the better option? We cannot reduce the payment. It is 5 crore and we will have to pay. Let's round off the difference. Come with me. I'll write it here. Balancing figure. Five crore minus 473, 71180. 26 lakhs. 28,820. Tell me the total interest. How much is it? 3095,180 plus 26,28820. 57 lakhs 24,000 rupees. The purchaser should write off the interest expense of rupees 57 lakhs 24,000 in the profit and loss account. Instead of capitalizing it at the cost of property. In the property, there is no need to add it to the property cost. We'll expense this in the profit and loss account. And I don't think there will be any problem with this question for you. The purchase was made by cash. Self-construction. The deferred credit has been completed. The example and question also done. Now everything should be absolutely clear to you. I have a question for you which I am giving you as homework. I have a question. I am giving you homework. Question number 10. This is your homework. There is no accounting to be done in this. There's nothing to do. You just need to tell a note. What will we do with the interest? For example, you have purchased a piece of land for 1 crore, but you have to make the payment after 2 years, and that payment is for 1 crore 20 lakhs. You bought land for 1 crore, but you need to pay 1 crore 20 lakhs. Okay? Then what is this 20,000 rupees? This is your interest. You were asked that what should be the cost of the building under both payment methods? It has the option either to pay full payment at the time of the purchase or pay it after 2 years. If you pay now, it will be 1 crore. 2 years later, it will be 1 crore and 20 lakhs. Tell me. Students, now the question is that what is the cost of your building in both options? So the cost of the building will remain as 1 crore in both options. Alright, so either you pay now or in 2 years. The cost of the building will remain 1 crore only. The extra 20 lakhs you are paying in the second option is the interest cost, which will be written off in the profit and loss account. We don't capitalize it. This is the beauty of this concept, students. We don't even include interest. Whether you buy it in cash or on credit, your books will not fluctuate. The books will record the same cost that is incurred. Look at this. Using either payment method, pay through any method, the cost will remain the same as 1 crore. If the second payment option is used, 20 lakh rupees will be treated as interest expense. We record this in the P&L statement. We will Write-off. Interest expense in the profit and loss account. We can also add this line in it. This is your homework, students. Such questions are not on the exam paper. But the 18th question can be worth 5 or 4 marks. There is a lot to do in it. What would you do here? This is just for understanding. What does it do? This increases the number of questions in our book. Clear? The more questions asked, the stronger the impression that the teacher might have given many. The questions that are relevant, and you can tell which questions are relevant to the topic by reading it once only. I will give you a list. I will, at the end of each module, in your book, at the end of each module, I will print a list of the important questions for you, okay? And if you don't see that list in the module, no problem, I will share it on Telegram. I provide the list of important questions to all my students. Let's move on. Okay, what should we do now? Case 4. Exchange of assets. Case 4. Exchange of assets. And then you mark it as important. The problem that I marked as important, it's included not because it involves very complex concepts, but this is important because its reference will come up repeatedly in upcoming Ind AS. This is Ind AS 16 of PP, which includes the concept of exchange. We'll cover Ind AS 38 intangibles and refer to it then Ind AS 2 as well. Whatever we learn and understand here, we will carry that understanding forward. A concept working across 3 or 4 industries is important for us. Like deferred credit will be used in the future, this is also useful. Students are wondering what is the meaning of exchange of assets. Exchange simply means that taken up, given up. The term taken up refers to what we have bought. What have we received? This is very basic, I feel. We are studying Ind AS 40 and the title of Ind AS 40 is investment property. So we have purchased this property. And what does given up mean? What did we give in exchange for this? In exchange, we have given our own assets, okay? Did you understand? If you make the payment in cash, if your payment is made in full cash, then it is a cash purchase. Is it clear? But everyone, if you are buying an asset, and then you make the payment in other assets, plant and machinery, land and building, furniture, other assets. Did you understand? When we buy an investment property and instead of paying for it in cash, we can exchange one asset for another. We bought an asset and then paid with an asset itself other than cash. So the student asks, is there no cash involved? Cash may be involved, okay? But in a very small amount, alright? Enough amount that balances the transaction, okay? However, your main content, your main asset will remain unchanged in this process. Let me make you understand. I bought a car from the market, okay? 20 lakhs. And in return for that, I am exchanging my old car. My old car is worth 11 lakhs. A 20 lakhs car won't be available for 11 lakhs. You will need to pay 9 lakhs extra, right? So, cash is involved in the transaction because it creates a balance. There is a possibility that you might have to pay with cash to satisfy the other party. It is possible that the value of your asset is not as high as the other party's asset. So cash gets involved in between, but you will exchange your assets first, okay? You are taking a new asset and giving away your old asset, understood? This concept is called an exchange of assets. Okay, suppose if you make the entire payment in cash, then it will become a case of cash purchase. We have purchased an asset, but the payment has been made with another asset. And you can donate your plant, machinery, a car or furniture, anything for that matter. You can even exchange an old machinery or a land for another building or a factory. And it is possible that some cash may be involved in the transaction to balance it out. This is called an exchange. One more thing, taken up investment property for the other assets given up. So do you know that this whole accounting, this whole concept, it is dependent on just one word. And that word is commercial substance. If suppose in an exchange, pay attention, for example, commercial substance also exists. So accounting will be done differently. And if there is no commercial substance that exists, then accounting will be done differently. Understood? The accounting model is a little different because of the commercial substance. And accounting model will be different when there is no commercial substance. Now you're thinking that what is this commercial substance? The definition of commercial substance is clearly written in Ind AS 40. And according to Ind AS 40, listen carefully, okay? That if, let's say, if, so to speak, if the benefits of taken up assets differ from the benefits of the given up assets, understand this. When you use the asset that you've bought, then eventually your business will benefit from it in the long run, right? The benefit is in the form of cash inflow. So Ind AS 40 states that if the cash flows of your taken up assets differs from the cash flow of given up assets, the asset that you were using, the asset that you gave up, you were using this, right? It's an old asset. Understanding my point? The asset that you were using and simultaneously generating cash flows. If this cash flow do not match the cash flows of the incoming assets, so now we will assume that commercial substance does exist. Okay? Is this clear? Suppose if the cash flows of the incoming asset are different and don't match the outgoing asset amount, incoming do not match with the outgoing, and they are not replacements for each other, which means the benefits we have are the same. The old asset has gone and the new one has arrived, but it has not affected our cash flows. Then this is not an exchange. No, not at all. There should be a difference in cash flow. Okay, tell me. If you buy a new car and trade in your old car, will the performance of both cars be the same? Tell me. And if the performance would have been the same, then why would we exchange it, right? This shouldn't be said, you know. The cash flows from the new asset will be better than the old asset because then only exchanging them makes sense. If this is the case, then we will be assured that commercial substance exists. Is it clear? And your accounting is based on the fair value model. I hope you understood this. If the cash flows of the incoming asset are different from the cash flows of the outgoing asset, and they will be better, of course, as it's a new asset, so then we will assume that commercial substance exists and your accounting model is the fair value model. Alright? And if we both have the same cash flow, then there is no difference. So then we will assume that commercial substance does not exist. Okay? So what will your model be? A book value model. Now what is this model? How does it work? I can only explain it to you with an example. I have a lot of examples that I need you to work through. Then only you will be able to understand this. Okay? So now, first, let me quickly summarize this much of the topic for you. As per the provisions, As per the provisions of Ind AS 40, an investment property may be acquired in exchange of other assets the accounting for exchange of assets shall be made in following two different situations. If we talk about the exchange of assets, then there are two cases in this. Situation 1 and situation 2 now. If commercial substance if the commercial substance so if we talk about commercial substance, suppose now the commercial substance, let me tell you the meaning of it. You should note it down like this. So commercial substance means cash flows from taken up assets are quite different from given up assets cash flows from taken up assets are quite different from the given up assets. Okay. If the cash flows are the same, then why the exchange? Which means there is no commercial substance. Whether you exchange the asset or not, it won't matter. The ease of exchanging assets is only when there are changes in your benefits. Now please make a heading. Situation 1. If commercial substance exists, well, I came with a mindset that we will cover all the concepts today. However, we've almost been recording from 2 hours now, so I'm keeping the video on hold for today and we'll pick up the next video from here itself. The recording is done according to our syllabus. And moreover, you have all the content you want to watch. All the videos are available to you every time. Watching these videos will be helpful for you. This is how I follow the plan. Okay, so let's wrap the class for today. I'll start the next video from here, and in the next class, I will try to explain concept number 5 and complete initial recognition. Plus, then we will start with concept number 6, subsequent measurement. Okay, students. Thank you very much. Take care. Bye-bye. See you in the next video. Okay, should I give you 1 or 2 questions for homework? Only 1 or 2 questions for homework? Okay, students, let me give you just 1 question, alright? This is question number 23. You can read this yourself, okay? Just read this one yourself. This is your homework. Thank you very much. Take care. Bye-bye. See you